we thought we'd talk about crypto today, and we thought we'd talk about simplifying it with just a couple indicators. And it's going to be a twist on some standard indicators that you guys have probably heard of before. Kieran knows what these indicators are already, but he's not going to give anything away. Like one final thing I'll say before I get going is, what's with all the boxes? Is this Amazon? Like, what are all these boxes doing up here? It's a really nice graphic I've got on my screen, but Zoom's kind of screwing it up on here. So just picture this nice factory line of boxes coming off. And that sort of, to me, is the way that we envision the company that we have called Our Factory, which is up there as well. My partner Sonal's here in the front. She's my life partner. She's my business partner. We started Our Factory together. We are first and foremost traders, so we just trade for ourselves, but we also build automated systems and indicators and tools and that sort of thing, amongst other things. But the whole idea sort of behind Our Factory is R. And I want to get this out of the way up front, the concept of R. Is anybody familiar with Van Tharp? Stuart, clearly, and Kieran. So Van Tharp really kind of popularized the idea of R. Ralph Vince is said to have done some more work on that ahead of time. The way I think of it in simplistic terms is that R is return. And so we built a factory to create return. That's how we try to think of our business. So in order to get that return, which you could also think of as reward, you've got to put something into the factory, right? There's got to be some raw material that comes into the factory. And that raw material is risk, another R. And so the units of risk that go into the factory and then that come out the other side, hopefully in a bigger way, that is the R factory that we always think about. And we picture it as a factory line of boxes where each one of these factory lines could be an individual trading system, and they're all just producing return. And the idea is that we combine lots of different trading systems together. Some of them are run automated, some of them are run manually, some of them are discretionary or have elements of discretion, some of them are just totally mechanical. The idea is that they also operate on different markets and on different time frames. And when you put all of these things together, you're getting this constant stream of R coming out of the factory, which is just what is building up our business. Okay, so consider yourself disclaimed. We'll move swiftly on from that. Roughly, this is what I want to go over today. We'll do a quick welcome and some backslapping. You'll see what that is in a minute. And then I'll take you through some ideas of a system, like one of those factory lines that I want to talk you through. And I think you'll be interested in it because there'll be some little tweaks on things that you probably know. And then we'll just talk about, why crypto. We'll talk about how we automate it a little bit, and we'll get some results. So just before we get going, this is where the backslapping comes in, and it's important because we're all sort of standing on the shoulders of giants or greatness here. And there are three in particular that I want to point out tonight. Dr. Van Tharp has been very influential for me. I've been out to Cary. They run a facility called the Van Tharp Institute out of Cary, North Carolina. And we unfortunately lost Dr. Tharp earlier this year, February, I think it was. So he's no longer with us. But his legacy remains and his institution remains. And in fact, I'm going to talk about the components of the system one of the systems that we're running today, but we've actually put this together as a course and a workshop that we are teaching at the Van Tharp Institute next month in November. So we've got quite close ties with the Van Tharp guys. And when I say I'm going to skip over Ken for a second and go to Bill. Bill is a colleague of mine who I've been working with for years out of the States. And so him and I have developed this system and these ideas really on the back of a bunch of work that Dr. Ken Long has done. So we've both learned from Dr. Long for quite a few years. He is a personal friend, a teacher, a mentor, and many many of these ideas are his, really, and we've tweaked them in various ways with his blessing. So he's aware that we're out here doing this, and he's quite happy that his students are taking up the rail and continuing on. That greatness keeps going. So there's always friends in the room that keep that greatness going. So Stuart's in the back. He's laughing because he's in the photo here. But there are friends here from the STA that I've known for many a year, and as I've come along here, when I first started, I think it was 2009 when I passed the exam, and I didn't know anybody, and I eventually found these guys down the pub around the road, and we would always go there after the meetings and just kind of have a chin wag, talk systems and other nonsense, and anyway, it's made my experience at the STA what it is really is, and it's not just these guys here, but it's everybody at the STA, and extends to the board and many more friends that I now have. A brief sales pitch for the STA to you guys who are maybe on the meetup group is that you can join as what's called an associate member, and it's only 75 pounds a year. If you're a student, it's 25 pounds a year. It's a no-brainer. You get to come along to all these events. We've got parties like the one you can see here, and there's JP Morgan runs that we participate in. There's a journal twice a year. There's endless benefits really to joining in. So I would encourage you to do so. All right, let's get into it now. So I'm going to be using TradingView as a charting package today. It's easy to use. I like it because it is quick. It runs in a web browser if you want it to, and it has a coding language bolted into it called PineScript, where you can do all kinds of coding work. Now, this is just sort of like a teaser, and we're going to build ourselves up to it. And I've been toing and froing as to whether we should just do this in slide form, which may be a bit boring. I always think slides are a little bit boring, or we could just do it directly on the charts. What do you think? Charts? Yeah, what's a little risk, right? What could go wrong? All right, we'll do it on the charts then. Okay, let me just move away some of this Zoom stuff. All righty, so can you guys see that clearly enough? Just check it. Do I need to zoom it in a bit more? Yeah, of course. Yeah, go for it. I'm actually going to change this to ES futures, so S&P 500 futures. This is a daily chart, and I'm going to zoom this in. Let's zoom this in a bit so that it's more clear to everybody. Yeah, that looks pretty good. Okay, so this is obviously just a candlestick chart, and the first concept, right? So there's going to be three indicators here today, right? And so the first indicator that we're going to touch on is regression line, right? Hands up, who knows regression lines? Okay, we've got a few. It's okay if you don't. I'm going to tell you what it is anyway. I don't. And okay, so let's do this then. I'm actually going to switch this to bars, which is going to make it harder for you guys to see. But what I really want is to get to closing prices only. And then as I was sort of doing a bit of prep for this, and I was like, what can I talk through here today? I realized it's really hard to do closing prices only in TradingView. It's just not really part of the default thing. So I had to just whip something up. Which is why it's nice having a coding language attached to it. So these orange dots here are the closing prices. And then what I'm going to do is just a little bit of trickery by switching to a line chart, which is invisible. And now we're just seeing a scatter plot, essentially, of closing prices. Everybody with me so far? Okay. Now, what I'm going to do is add in a regression line. So I think it's that one. No. That one. Okay, here we go. Okay, so a regression line is a best fit line. So if we've got a scatter plot of a bunch of different data points, what we want to do is say if I'm going to draw a line through all of the points and have it so that each line is as close to the point as possible. That's what it is. And there's a formula for this. So it's totally mathematical. I think it's also called the least squares moving average. Getting some nods. Okay, good. And you could think of it a little bit like a moving average, at least the piece that I'm going to come on to in a second. But the line itself is just a line, and that's what we're looking at here. Now, we can do other cool things with the line, like I can go and add a channel onto that. And so now I've got a regression line channel, and then I've got some standard deviation bands above and below. And so that way there, I can kind of get a pretty good idea of what should be containing all of those scatter plots that we're trying to draw the line through. But for today, we're only really interested in the line. And in fact, we're going to get rid of the line as well. We're just going to use it to demonstrate. What I'm really getting to, guys, for those of you who might know, is a moving regression line. And it looks a little bit like a moving average, but it's built up of something that's different from a moving average, right? So, hey, Kev, you missed your photo. I put it up earlier. All right. Okay, so next up, we're going to add in a moving linear regression line. And so the blue line that's come up there is that moving line. But what I want to do is show you how that line is formed, because it's all based really on that purple linear regression line. So a way that we can do that is I'm going to flick this trading view chart into market replay mode. And in fact, I'm going to do it from an extreme, so from right about here. So that just kind of backs the chart up to wherever I just grabbed it. And now you can see that we've got the purple line and then we've got the blue line. They're actually kind of on top of each other. And what we're going to note is that the most important thing is that they both intersect at the end of the linear regression line. So really what we're doing, and as we move this forward in time, is we're just tracing along different new data points and connecting the dots with the blue line to where the end of the purple line is at every stage. So I gotta find there it is. Everything's hidden behind the little weird zoom things. So now if I roll forward one dot, you can see that we've now got a new data point. And in fact, I'm going to put a dot there. And now I'm going to do the same again. I'll only do this a few times, but I just want you to see how that blue line is formed by just tracing the end of that purple line. You guys get the idea? So now if I do this a few times quickly, you can just see that we just watched that whole blue line get painted as we rounded out the corner there, right? Okay, so indicator number one, linear regression line, specifically the moving linear regression line, AKA regression line curve, AKA least squares moving average. Okay, so what's next? I forget. Okay, so what I'm going to do is let's get rid of all of these guys just for a minute. And then let me get out of market replay mode here. There we go. And in fact, well, I'll just leave those dots there for now. They're not going to hurt anything. Okay, so let's go back to candles for a second, and I'm just going to zoom this out. Now, the next indicator that we're going to talk about is PSAR. So number two, PSAR. But we're going to tweak it a little bit. So before we do that, though, let's throw a usual PSAR on. This is just a standard PSAR out of the box, and that's the yellow crosses. I will get rid of these just so that they don't get in the way. Okay, so each one of the yellow crosses is the PSAR. Is everybody familiar with PSAR and how it sort of works and what it does? Not seeing too much. Okay, so the general idea of the PSAR, and by the way, it means the parabolic stop and reverse. It was an idea, Wells Wilder, if I remember right. Hope I got that right. Came up with the approach, and the idea is that it's a stop and reverse system that's always in the market, and you are either long or short at all times, and it also essentially trails price until price pokes through it, at which point it flips to the other side and then continues on again. So if we were to look from, say, this point right here, the green bar, hopefully that's nice and big, this green bar pokes through the PSAR, which is just behind it, and then it causes it to flip to the other side. And now at that point, we are essentially in uptrend as far as PSAR is concerned, and then we're trailing it up, and we're trailing it with this mechanism here, and it's called parabolic because it uses a calculation that essentially makes it look parabolic. It accelerates close to price as price moves in its favor. And it's quite a nice indicator. I've done a lot of work with PSAR before, but it has limitations. And some of those, excuse me, some of those you can see here. Now, the obvious limitation is that you get kind of whipsawed sometimes, right? So you can see just here, price poked through just a little bit and it caused it to flip to short. So now if you were trading this system and you're always in the market, you're long, short, long, short. Sometimes it's great when the move is going your way. Sometimes when things are a bit sideways, you're just really kind of getting chopped up. So we can see some evidence of that here. And then even just here where, we had this pullback just recently and then it collapsed again. And then even now we were back in uptrend mode, but now we flip back again. So that's a general limitation. What we're going to do now really is offer a slightly tweaked result on that. So if you can see through these, the light blue dots are essentially the long trend, and then the purple dots are the short trend. And so what you can see is that the trend is holding for much longer than it did with the classic PSAR with the yellow crosses. However, if you pay really close attention, you can see that price also goes through. Okay, so the price is going through the PSAR, but we're not yet flipping it over. And so this is where the two indicators I've talked about so far, the RLs and the PSAR, come together. Dr. Long, who I mentioned before, likes to think of the RLs as short-term RLs, I should say, or short look-back RLs are a great proxy for price. So price is noisy, and we can get whipsawed with price, but when we've got if we were to pay attention to the moving linear regression curves instead, we're actually just eliminating that. We're essentially summarizing a bunch of that data into a line, a bit like a moving average, but it's much more adaptive than a moving average. So if I were to add back in the moving linear regression line, and now I'm going to take away the classical PSAR, and then I'm actually going to take price away again. And let's go ahead and take our scatter plot off just so it's not confusing. So now really what we're left with is that moving linear regression line. I think this is a 20-period look back one. And then we've got the PSAR that goes along with it. And what we've changed is the input to the PSAR algorithm is not using open high lows close prices. We're using that linear regression curve instead. So we're eliminating a lot of that noise, and we're allowing price to penetrate through the PSAR at times, but not change the trend. So we end up with a much more stable version of trend. It's certainly when the market's moving and not when it's going sideways. There's still a sideways problem, which we'll come to shortly. Okay, so that is the bulk of the inputs that we're looking at for the system that we're using here. And the system is called the PRX system. That's what Bill and I have ended up calling it. And it is the P is a PSAR, the R is the RL, or the moving linear regression curve, and the X is essentially a cross or a flip. So PRX. So what we're doing is just we're paying close attention to when this RL line is causing the P sort of flip over, and then we're using that as a trend, and then we're trying to hop on and stay on the ride. Now, if I move on to, I'll give you one more quick comparison that I forgot to do earlier, which is a comparison between that moving linear regression line and a moving average. So the green line is a simple moving average of the same look back. I think it's 20. And really, I just wanted to highlight the differences, and that the RL is quite a lot more adaptive in the same look back period. There are some other interesting qualities to the RL, such as it can actually go beyond price. So what I mean by that is if I turn price back on here just as candles, and we don't have anything too extreme on this chart. This is probably the most extreme point right here, where the moving linear regression line is just peaking here. But you can see that we actually peak at a point beyond the closing prices of the chart, and meaning higher in this case. Does that make sense? And that just wouldn't happen with a moving average, right? You're always kind of dragging this average along with you. Whereas the moving linear regression line is actually sort of forward-looking forecasting. In fact, you can extend that line that we were looking at before to just point out into the future endlessly to try to get a read on where we're heading. But that also means that there's interesting things that we can do with that with regards to knowing even before the PSAR gets flipped over, I can tell you where the PSAR is going to be. So I can kind of get a heads up from that. Okay. Now there's one more element that we make use of. We've been through the 2 of the 3 indicators so far. The third one you're going to get disappointed with is just a moving average, and typically something kind of long, like a 200, and it's a trend filter. Simple as that, right? It's because if the market's collapsing around you and you're trying to take advantage of it with by hopping on the trend in this way. But if it's just trending against you and you're just catching these little pullbacks in a downtrend, you're not really getting anywhere. So that's important when we come on to crypto, because crypto, in case you haven't been paying attention, hasn't been the strongest market this year. But it was previous to this year. So worth paying attention to. All right, so let me move on here. And what I want to do is I'm going to pull together a flavor of the system that we're using. And so let's go to I'm going to switch this to a Bitcoin chart. We'll stick with the daily, but we're going to zoom out quite a bit. And I'm going to turn off most of these. Let's turn that off, and then I'm going to enable the trading system. And so I mentioned that we're putting a workshop together. I can't give you everything in the system because it's just not fair on the guys coming along to the workshop already, or all the guys that have put the work in. But I'm actually giving you a lot of the guts of it, right? Which is like, these are the components that we're using to put all of this together. And we've used it in quite a few different ways, and then figured out what are the good sort of filters that seem to be sensible. And also, what other modifications to the system can we instill that kind of like help us to get back in on some of these, because sometimes you'll get whipped out anyway. And these crypto trends, when we originally designed the system, the whole idea was to be able to hop on to crypto trends, right? We saw crypto was going crazy. We didn't want to be the buy and hold, the hodlers, because our general philosophy is that you need to manage your risk. It comes back to those boxes we were looking at in the beginning there. I've only got my risk unit that I'm willing to risk on this. I don't want the thing to go 70% against me or anything like that, but I'm willing to take a trade and see if I can let this thing grow and then trail it up using some of the mechanisms we've been looking at so far. Okay, so a little bit more info here just on what we're looking at. The red sort of C, the rising or now dropping red tide is that average, the moving average. I think it's just a 200 here. And if I'll zoom in on a few different areas here just so you can kind of see what's going on. But the general idea is that when it's a long only crypto system, at least it was originally designed to be so. And part of that is because my colleague Bill is based in the States, and in the States they are extremely limited in what they're allowed to do with crypto, too much so in my view. And so it's very difficult to go short. It's actually very difficult to get access to a lot, and they also have almost no use of margin available. Whereas over here, we have a lot more flexibility. So there's quite a lot of margin available. We can go long, we can go short. There's perpetual futures available now. But regardless of any of that, there are mechanisms you can use even in the States to take advantage of these things. And when we first started looking at it, it is a swing-based system. So it was just based on end of day charts. And it was like, okay, wait, hang on, crypto's going up. I should have this in bar mode. So, you know, we want to be in. We want to be long until that trend ends. And so using something similar to what we were just looking at, you know, there's a long entry in here, and then essentially we're following this PSAR until we get an exit signal, which is just around here. That doesn't always work like any other crypto or any system really. There's another re-entry here, you know, right at the peak. And that is probably the peak, I think, probably the next day. I don't think we've retested highs since then. But, you know, we took a small loss on that, and that's okay. Oh, it looks like we found another entry here. And then once we enter the Red Sea, we're basically just sat back and not doing anything. Now, since then, it's like, okay, well, hang on a second. Well, what do you do when the market is under the 200 average forever? There's got to be a lot of opportunity still going on. So we've looked at shorter time frames. We've done a bunch of intraday testing. We've done short testing. And all in all, the system actually performs quite well throughout. There's a few things that you need to bear in mind based on some of those time frames. There's execution costs. It's a bit different in crypto than it is in different other markets. But the principle's the same, right? There's an execution cost, there's slippage, and then you want to kind of go to the marketplace where there's the most volume, because not all of the exchanges are equal. Interestingly, the perpetual futures contracts are extremely liquid. And you can also get away with quite specific position sizing, another benefit on the crypto side. So rather than being stuck in single contract sizes for some other sort of future, like you can also take advantage of this through the Bitcoin CME future or the Bitcoin micro, or is there a nano one now? Maybe they came out with a nano one. But the sizes were still kind of big. If you wanted to get, you know, if you wanted to dip your toe in, you still needed a fair amount of money to partake in these. Whereas if you can go direct to the crypto market or the perpetual futures market, you can actually get very specific sizing. We've been doing prototype testing on a number of different time frames, markets, using $1 risk at times, just to see. I'm just trying to get some data here. Let me see, what am I end up paying in commissions and that sort of thing. And that's great, because otherwise you'd find out the hard way after you've lost a bunch of money. And you're like, oh yeah, well, that didn't, either the system didn't work or the commissions were too high or a bit of both. And yeah, okay, now I've got to start and do something else. So anyway, just a lot of flexibility there. I'll show you this briefly, just in TradingView here. The main areas when the system performed best, of course, was during the large the large uptrending market that we saw towards the end of, or I guess towards the beginning, middle of 2021, where you would just get these really nice uptrending moves, and then the market would pull back, and then you could hop back in again. As part of the workshop that we're putting together, we've got these indicators and systems all kind of put together, along with the dashboard at the top here that essentially shows you the position at any one point in time. So we've kind of tried to make it easy for people that aren't familiar or who aren't familiar with crypto. And one thing that's nice about TradingView is that we can put these together, and then I think I can make this whole pane big. You know, this is an example of an equity curve that comes out of the system, right? So this is on $1,000 risk, and I think this is probably over about. Let me check the time period here. I've got some better stats on this in the PowerPoint, which I'll jump over to in a second. But yeah, I think we're probably going back to around 2014. But you know, 212 R units over that period of time is nice to see. And you can see from the equity curve that there's actually some very large R multiple chunks here where an awful lot of that money is made, but not exclusive. So that was kind of like early days into Bitcoin and crypto. It captures a lot of the profit, and then it sort of normalizes a bit, and it's still performing very well from a systems point of view from that point. All right, I'm going to flick back over to the PowerPoint deck, and an overriding concept that I didn't mention earlier really is that simple is better than complex. I think it's one of those things where technical analysis is a great example of this, because there are so many different aspects of technical analysis. And if you go through the STA course, you know, you learn about all of them. And you think, wow, there's so much there, there's so much to know. But you don't have to know it all. And you don't have to add them all to your chart. And I think many of us have gone through the exercise where you've added 1,000 indicators onto your chart and thought, okay, yeah, now I've got every view on it that I can. And then eventually you figure out that you don't need any of that. You can take 99% of that off and you're still getting the same information. And then you start understanding the categorizations of some of these indicators and ideas, and how, okay, well, I'm just going to pick one oscillator and they're all going to be very similar. And as long as I can understand that one, then I'll be able to continue and do well with my trading. So bear with me a sec, because I prepared this in PowerPoint form, what we walked through earlier, just in case. One thing I didn't mention, actually, I think you guys noticed anyway, but you know, when we put the PSAR on the RL, then we've got this point where, various points actually, where price is piercing through the PSAR, but it doesn't cause the trend to change. So I mentioned it, but I just wanted you to see it on the chart. Okay, so let's just talk some results then, right? So, okay, I'm talking about this system, isn't it great? All of that, and there's lots of different ways of trading it. One of the initial ways that we started to trade this was through the US, and it was through two ETFs in the US. And they were called GBTC and ETHE. And GBTC is a Bitcoin ETF. ETHE is an Ether ETF. Now, it's not your classic ETF. It's actually over the counter. So it's not really an exchange traded fund at all. But they were over the counter products. It was the first sort of thing that was available, the earliest one. And then we managed to get a bit of data through, and we got some history. And we started to apply it specifically to these. Now, these trade just like any stock in the US, with a few little tweaks, in that you have to use limit orders to enter, strangely. And I think that's about it. And then you have to look at the prospectus for the actual thing that you're trading. But these are fairly liquid in the US. And now I think proper ETFs are coming on the market, even though it took a very long time in the States to get that to come through. By the way, quick aside, I'm talking about this system with regards to crypto because we originally designed it to try to take advantage of large moves in crypto. It's not limited to crypto. You can do this on anything, of course, right? In fact, we've tested it, and it works quite well on numerous markets. So but it's got an interesting use case in crypto, specifically with the altcoins, which I'll come on to in a second. But these results here, I'll talk you through briefly because this is sort of in a format that we tend to look at it. I'm aware that you guys probably may not know what all of this is. Really, we're just looking at the data in a few different ways. There's a scatter plot on the bottom left there. The average R is essentially like what is the expectancy as we're moving through time. Expectancy being like what's the average trade outcome, what's the average size of that box coming off of the conveyor belt. The cumulative R is obvious, I think. That's the equity curve, the blue line specifically, and then there are some averages of the equity curve, so we can just get a read on how that equity curve is moving over time. And then we're looking at a histogram in terms of R multiples, so that would be how the R box that we saw at the very beginning there. That's our unit of risk, and then the idea is how many units of reward are we getting off of the back end of that. And we would expect to see something of a histogram like this, where the left-hand side, that's the -1 R area here. Those are the trades that just didn't work when we took a full R loss on. So we lost that. That was like breakage in the factory, right? So the box just fell off, got broken, and it's no more. And then as we go into the zero bucket, that's something that made up, it was a small box. It made a little bit, or maybe it lost a little bit, but it kind of did what it normally does. And then as we go out to the right-hand side here, we can see the growing sizes of those boxes as they came out of the factory. The ones on the far right-hand side are the best trades. Those are the ones that have these large R multiple winners, okay? What I pay attention to on this chart here, primarily, or at least these numbers, is the expectancy number here. That's the average R gain. So for a 1.29, these are all in R multiple units. So we managed to create every box that's coming off of the conveyor belt is making 1.3 times the risk that was used to come into it. That's unusual. That's unusually high for a system. Bearing in mind this is a daily chart, we know we were through a bullish period on this, but nonetheless, the numbers are quite good. And the other metrics that stick out to me is reliability. That is essentially win rate. So it's a 50% win rate. So we win on half, we lose on half. The difference is when we win, where's the metric here? Win-loss ratio is 5.2. So Dr. Ken Long would say that's a coin flip that pays out 5 to 1. So, how often would you want to take that coin flip, or how often would you want to take that trade? As many times as you possibly could, right? The results up here are based on back tests, but the results here are full production size. But that means not prototype size, where we're just, we're trading live on small size. That's what we call prototype. That says we're kind of gearing the factory up. But full production size is like, okay, this is the size that I actually wanted to trade the thing on in the first place. And really, the idea here is just to show that that once we got into production, things carried on as normal, and the numbers were roughly equivalent and in line with expectations. I'm not going to go through it here tonight, but we do a lot of rigor around the statistics and the numbers on this, and we take the outcomes of the system, we run them through Monte Carlo simulations. We want to figure out at what point is the system no longer working, and if we're going to implement the system, get it live in that factory, at what point do we need to turn that system off because it just stopped working and it's broken, right? So I don't have time to go through all of that here, but we spend a lot of rigor in that part of the process. I'll just talk through a couple of the edges here, and there's a bunch of these. I won't go too far with it, but these are edges of the system and the reasons why we like it. And I say we, this is sort of Bill and I, and it fits our personality types for what we're looking for in a system of this type. Simple was one of the biggest things, right? We wanted it to be super simple as well as robust. And with simple, you tend to get robustness. Okay, if you overly complexify something and the results look really good, chances are you've curve fit and you've gone a bit too far, and you're never going to see results like that in the future, right? The rule set's really simple. It doesn't take a lot of time to run. You don't really have to know anything about crypto to run these things. And there's lots of different methods for implementation. You can run this on the ETFs like we showed. You can run it on futures. You can run it on the crypto direct, on spot. Pick your exchange of choice. And one of the other ones was that it's fractal based, or it is fractal, meaning that we can drop the time frames down into intraday time periods and carry on as normal. And it's essentially the same. You always got to be aware though, right? I just kind of wanted to put this chart in because I like the lightsaber going through it. But be aware. No system really is holy grail. Things work for a while and they don't. So that's kind of just an idea of just like we're always cautious and we're always watching to make sure things continue to work well. And then just a couple slides here on the market filters. I mentioned like a 200 simple moving average as a nice simple filter there. This is that GBTC one when it went a little bit crazy. And we were in that trade and then gave a lot of the trade back. That's going to happen. That's going to happen too. There are probably ways that we can improve that. But that you start to get into the how far do you go with trying to pick those nice exits, and that's going to look great in the back test, but you'll probably never see that again. The point here really is that with this system with the moving average filter on, only a few trades in the little sample here, and you can see the numbers. If we don't have the moving average filter on, you can see we're now taking trades inside or underneath that red tide. So now we've got trades happening there. The net outcome is about the same. It's about 32, 35 R, something like that as a result. But we've got double the trades, the win rate's lower, the drawdown's higher, and it's just kind of not worth it, right? So it's just being aware of those pieces. Okay. We talked about some of the big guys, Bitcoin and Ether. There are loads of cryptos, right? And I don't even know much about a lot of them, but there's loads of altcoins out there. People keep making them. Some of these are going to make an awful lot of money. I don't know which ones. I'd like to try to take advantage of it if I could. And so what we did here is we ran through the same exercise, the same system on 86 different altcoins, and put it together as one big basket. Okay. And overall, the results are actually quite good. And what's nice about it is it will get you out of the trade. And it will also get you into the trade. And that's one of the harder things, right? And it's like, well, what do you do? Just buy them all? And another strategy, Bill does this one actually, is he just has a basket of altcoins because he kind of knows that, okay, out of 10 of these, 8 of them might go to zero, but one of them might go to 1,000. And if that's the case, then overall it might work out okay. But we like to be a little bit more careful with what we're doing. So this is just an example of running this on the altcoin system, and we added a couple extra filters here just to kind of keep A, portfolio heat under control, and B, just making sure we're on the right side of the market again. Well, what about Luna? You guys heard about Luna maybe a few weeks back, right? Yeah, it went to zero. That was one of those ones that went to zero. So can that happen? Yeah, of course it can happen. Will it happen again? Probably. I think nobody thought it would happen to Luna because there was just a lot of interest and a lot of money in it. And yeah, it essentially went to zero. Now, there were multiple filters that would have kept us out of the Luna trade or would have got us out of it. One of them would have been the moving average filter ultimately. But you can see here, even without all the other filters, we had 3 wins on this, 2 losses, and the whole thing basically scratched out, and then it really took a dive. And the idea here is that there's normally a bit of a tell before things go catastrophically wrong. It often doesn't go from the absolute high to zero. It normally sort of wanes for a bit first and then goes. And so really we just want to have a quick look at that. And another quick thought experiment before we wrap up here is, well, what if crypto, since we're talking crypto today, what if crypto is a bubble? And what if it was a bubble, I should say, and we've already seen the top of it, and it was right there, and that's basically the crypto market popping, and we're not going to see that again, or we're not going to see it again for a while. Okay, this chart is actually the Nasdaq from the dot-com bubble. So, and it's from the absolute peak, and we only started trading it from the point at which it had actually peaked using the same system. And so, the idea here, I think, here we go. So if you bought and hold this thing and you were really unlucky and you were the guy that bought the peak, then that thing came down 71%. But if you ran a system on it where you're being that little bit more active, and then the PRX system, for example, we've got 16 trades here. It's obviously not doing fantastic, but you're only down a couple of R, and your max drawdown was less than 3R. So much more easy to stomach that sort of thing than just kind of holding on once you get stuck at the top. I'll leave this up just for a minute. This is just some of the results on different time frames that we've been testing. In fact, there's more than different time frames. There's different time frames, and there's different products. We've got Bitcoin spot, we've got Ether spot, we've got Ether Classic, which is subtly different from Ether. We've got GBTC, which is one of those ETFs we talked about, and ETHE, its equivalent, and then a couple other sort of, I don't know, I guess you'd call them altcoins, but XRP, Ripple, and SOL. And these are over different intraday timeframes. Now, the thing to bear in mind here is that the execution costs have not been accounted for in these results, and they'll creep in. And in fact, Bill and I have been doing a bunch of testing recently on various different timeframes here and different products to see how these things fare over time and what sort of execution costs and slippage we're getting. And the quick result on that is that, yeah, the lower you go, the worse it gets. That should be obvious. But it can be higher than you might imagine. And there are strategies, though, within crypto land to be able to get those execution costs lower. You can stake coins, which is basically kind of like putting money in with the exchange. So if you give them a whole big chunk of cash, they reduce your commission rate, essentially, right? There is changing the time frame just to make it that bit higher. And there's a bunch of other strategies you can do to try to just limit those execution costs as well. We so far have found that it looks like the sweet spot for us is more about 30 minutes and higher. Keeps you in the market, because also remember, it's a 24/7 market, not a 23/5 FX market, or even less if you're in some sort of equities or something. This thing runs all the time. And the side benefit of longer time frames is that you get less whipsawed in some of the quieter periods that do tend to happen sometimes. Sometimes it's over the weekend, but then sometimes the weekends are quite active, right? So I'm really encouraged by these results, because we're seeing a lot of the number I look at closely here is expectancy, really. That's sort of like my first port of call is, okay, what is the average trade doing? What is my factory producing? And if I can get an intraday expectancy of something like a 0.2 or higher, that's pretty darn good. And I can trade that system for as much as I can and really start to churn out some results out of the factory. And so you'll see, if you pay attention, obviously, if we just take this first green area, we're doing 60-minute, 10, 5, and 2. And the net R on some of these, right, 236, 286, and then it gets less and less as we kind of get into the lower time frames there. We're just getting into the noise. But the number of trades, to have 1,200 trades on the 60-minute, 7,500 trades, nice having that kind of sample size behind you, right? Now, regardless of whether you're in a bull crypto market or not, if you drop your time frame down to say 60-minute, 10-minute, 30-minute as a nice medium, you're getting a lot of different market cycles inside of that. And that brings me on to one of the final things we'll talk about today, which is, we've created a system out of this. And I'm aware I haven't told you all of the system rules because I can't give everything out on the talk today, but it's systemized. And what that means is that there's a very clear set of rules that you can follow, and you can either follow it manually or you can automate it. And so through the same system, I'm using TradingView here because it enables both of these. I can trade essentially whichever market comes around. They have broker tie-ins with a bunch of different crypto exchanges, or with things like TradeStation for US equity and futures brokerages. You can trade through Interactive Brokers now through it. There's a lot of options which would allow me to just run the system, trading it manually and just keeping tabs on it myself once a day, a few times a day, depending on what time frame I've gone for. Or if I want to drop it down to a short time frame where it's just like kind of too much to do manually myself, then there are tools available which will allow us to use the system, the same one that we've done our back testing on, and then hook it up through some plumbing through to the exchanges directly. And these things just churn away and trade on your behalf day in, day out. And we've been testing this over the last few months. It's working flawlessly, really, touch wood. So that's a nice way to sort of take advantage of the lower timeframes that we're seeing here, and just relieve yourself of really having to do too much to look after these systems. So really, that's what I wanted to cover with you guys today. I hope that's been useful. Hopefully, maybe it just kind of like opened things up a little bit, think about some indicators in a slightly different way. If you want to find out more about the workshop we're running, that's the website there. Our website is rfactory.io. And rfactory.io/PRX for the system, or you'll find it just off the homepage there as well. Funny thing about the IO, it fits in with the whole idea of the factory, because the IO is kind of a codey, geeky thing, a domain name extension, which is meant to mean input-output. So risk goes in, return comes out. That's sort of the whole idea there. So feel free to reach out to us anyway, and I would be happy to take any questions. The one thing I'll ask, and at the top I remembered, if you would like to ask a question, everyone has a little cool microphone thing. And if you wouldn't mind just grabbing the microphone, there's a little unmute button on there, and ask the question that way, and it gets recorded on the Zoom recording that the guys are using. So thank you. And if you don't have any questions, I can make some up. Pretty good at that.
I think one might say, dare I say, it was from an aged viewpoint that fortune favors the brave. I'm not sure that I'm brave enough to try, but it's certainly been most interesting to see how others are faring. And many thanks.
Thank you. Thank you.
Any questions?
Hi. Have you tried playing with leverage to improve the results?
Yes. Yeah, we actually do a lot of work on position sizing and playing with the leverage as well. The leverage is interesting, and actually we hit a problem with leverage when we started trying to implement some of these in the States, because you couldn't use any. And so for some of the short-term systems, we are it's beneficial to crank up the size, but what we're always doing is keeping that unit of risk the same. So even though our size, we may use 10 times leverage or more, but the size of the risk doesn't change. It really kind of depends on how large the initial stop needs to be, and that determines how big that risk is. And then we're sizing really for that.